Candlestick patterns are one of the most crucial factors in trading. Yet, you'd be surprised to know that the majority of traders use candlestick patterns completely wrong. In this video, we are going to cover everything about candlestick pattern trading from start to finish. So, here is everything we are going to cover today. Let's jump straight into it. 1. Candlestick Basics. A candlestick isn't just a red or green shape on your screen. It is a complete record of the battle between buyers and sellers during a specific time frame. Every candlestick has 4 main data points: the open, high, low, and close. The thick area between the open and close is called the body, which shows the real strength of the market. The thin lines sticking out of the top and bottom are called wicks, or shadows, which tell us how far prices pushed before pulling back. When a green candle forms, it means the close was higher than the open, proving buyers were in control. Conversely, a red candle shows that sellers pushed the market down to close lower. If you understand this basic psychology, you will never have to blindly memorize patterns again. 2. Long wick candle. When you spot a candle with a long wick on your chart, it is one of the biggest signs of rejection in the market. Let's say the market is trending downwards, and a candle forms with a massive lower wick and a small body. The psychological meaning here is that sellers tried to push the price aggressively lower, but buyers stepped in at those lower levels with such heavy volume that they pushed the sellers completely out, forcing the price to close near the top. This long wick proves that the sellers are losing their grip at that price level, and a trend reversal is highly likely. Don't just look at it as a single candle in your trading. See it as the first solid piece of evidence that buyers are taking back control. 3. Multiple long wick candles. A single long wick candle gives you an early warning, but when you see 2 or 3 consecutive long wick candles forming at a support or resistance level, you know that zone is incredibly strong. From a psychological standpoint, this means sellers are repeatedly trying to drive the price down, but every single time, buyers are entering with massive volume and rejecting the market right from that exact zone. When rejection happens repeatedly from the same spot, sellers get discouraged and start cutting their stop losses. This exact scenario lays the foundation for a massive trending move. If you want to learn how to spot these powerful setups on live charts, make sure you hit that subscribe button and turn on the bell notification. 4. Inverted long wick candle. The inverted long wick candle is the exact opposite of the standard long wick. It features a massive upper wick and a small body near the bottom. When the price is in an uptrend and this candle forms near a major resistance level, it clearly shows that buyers tried their hardest to push the market to new highs, but massive institutional sellers were waiting at the top. The sellers punched in such heavy orders that all the bullish momentum was instantly killed, and the price was forced to close near the lows. This inverted wick is a massive red flag that the buyers are exhausted, and we could see a sharp drop or a major reversal from this point. 5. Inside bar candle. An inside bar candle forms when a smaller candle, the baby candle, is completely engulfed within the high and low range of the massive candle right before it, the mother candle. From a psychological view, this signals a pause, consolidation, and uncertainty in the market. During this time, both buyers and sellers are catching their breath and storing energy before the next big move. The moment the next candle breaks out of the mother candle's high or low range, you typically see a very explosive and fast breakout. Traders often use this pattern to catch aggressive trend continuations or sudden, massive reversals. 6. Consecutive shrinking candles. When you look at your chart and notice the size of the candles getting continuously smaller, it is a direct indicator of a loss of momentum. Imagine the market is in a strong uptrend, but every new green candle is smaller than the last one. Prices are technically still going up, but the candle bodies are shrinking. This clearly means the buyers no longer have the aggression and volume they started the trend with. This is your earliest warning sign of trend exhaustion. In this scenario, you should avoid taking any new long positions because the market could reverse sharply at any moment. If you are finding this content helpful so far, smash that like button right now so this video can reach more traders. 7. Candles increasing in size. The exact opposite of shrinking candles is when you see candle sizes getting consecutively larger. This indicates a sudden surge of heavy volume and aggressive market participation. If the candle sizes are rapidly expanding near a breakout or a support/resistance level, the psychological meaning is that big institutions and smart money are actively punching heavy orders into the market. We call this building momentum. When candle sizes are expanding, retail traders need to recognize that the trend is incredibly strong, and the smartest decision you can make is to ride the wave in the direction of that momentum. 8. Candle color change. A sudden change in a candle's color isn't just a basic visual shift, it's a massive signal that market control has transferred overnight. Let's say the market was printing a series of strong red candles, but the moment it hits a key level, a massive, solid green candle prints. This color change is a loud announcement that the seller's supply has completely dried up and demand has taken full charge of the market. However, you shouldn't blindly enter a trade just because the color changed. You always need to read it in the context of support/resistance, volume, and the previous trend. 9. Momentum candle. A momentum candle is a large, full-bodied candle with little to absolutely no wicks, shadows. It is often referred to as a Marubozu. This candle represents one-sided dominance. If it's green, it means the second the candle opened, buyers took absolute control and never gave sellers a single chance to step in until the close. Momentum candles frequently form during major support or resistance breakouts. When you see this candle on your chart, it confirms that the breakout is legitimate and that the big players are actively driving the price. 10. Strategy and entry methods. One time frame. When trading on a single time frame, your entire strategy should be built around momentum and rejection. First, mark your major support or resistance levels on the chart. When the price reaches that level, don't just look for a random pattern. Look at the exact combination of the body and the wick. If an inverted long wick or a momentum candle forms right at resistance, your entry should be the moment the next candle opens, or right when the low of your signal candle is broken. Your stop loss must safely sit just above the high of that signal candle, and your target should be set for a minimum 1 to 2 risk-to-reward ratio. This method is incredibly simple and highly effective because it follows raw price action. 11. Multi-timeframe strategy. A professional trader never makes a decision based on just one time frame. In multi-timeframe analysis, you use a higher time frame, like the 1-hour or daily chart, to identify the overall trend and major key levels. Once the higher time frame overall trend is bullish, you drop down to a lower time frame, like the 5-minute or 15-minute chart. On this lower time frame, you hunt for a precise, tight stop entry using an inside bar, long wick rejection, or a momentum candle. The direction of the higher time frame combined with the timing of the lower time frame, when you put these two together, your win rate will skyrocket. If you want to improve your trading accuracy, don't forget to subscribe to the channel. 12. False candles and false reversals. Not every candlestick pattern works, and this is exactly where the majority of retail traders get trapped. A false candle or false reversal happens when a hammer or an engulfing pattern prints right in the middle of a trend, no man's land, without any key level or volume backing it up. Big players and market makers purposefully create these fake patterns in random spots just to trap retail money. There is only one rule to avoid this. Never trust a candlestick pattern that forms in a random place. A pattern only holds value if it forms on a valid support, resistance, or trend line. 13. Imperfect trades and zones. In books and theory, candlestick patterns look absolutely perfect, but on real live charts, you will almost never find a textbook pattern. In the real market, support or resistance is never a thin, perfect single line. It is an entire zone. Many times, wicks will poke out of your lines, or the candle color won't be exactly what you expected. As a professional trader, you have to accept these imperfect trades and train your eyes to see zones instead of lines. The moment you drop the expectation of a perfect textbook pattern and start understanding the buyer and seller psychology hidden behind the candlesticks, that is when you will truly become a consistently profitable trader.